Most people will never build real wealth, not because they don't earn enough, but because they're investing the wrong way. And if you think investing has to be complicated to work, you've been lied to. Because the truth is, some of the most successful investors in the world use simple strategies, and ETFs are at the center of it. So in this video, I'm going to show you exactly how to use ETFs to invest smarter, build real wealth, and avoid the mistakes that keep most people stuck. ETFs are one of the most powerful and beginner-friendly ways to build long-term wealth. And over the past 20 years, they've absolutely exploded in popularity. For a reason. But if you're going to use them the right way, no matter what the market is doing, you can't go in blindly. You need a strategy, a clear, simple approach that doesn't rely on guessing the bottom or reacting to every headline. And that's exactly why ETFs work. They spread your risk across hundreds, even thousands of companies. They make diversification effortless. And most importantly, they help you stay invested. Because that's how real wealth is built in any market environment. But how do you actually invest in ETFs? How do you choose the right ones? What about avoiding the mistakes that cost people the most? And most importantly, how do you build a portfolio that can handle the ups and downs of any market environment? In this guide, I'm going to break it all down, step by step. Everything I wish I knew when I started, plus a few strategies most investors completely overlook. So whether you're just getting started or you're looking for a simpler, smarter way to invest, this will give you a clear path forward. Let's start with the basics. What exactly is an ETF? ETF stands for Exchange Traded Fund. Now I know that might sound a little technical, but it's actually pretty simple. Think of an ETF as a basket of investments, like stocks, bonds, or even commodities that you can buy and sell on the stock market just like a regular stock. But here's the key difference. When you buy a share of a company, like Apple or Microsoft, you're investing in just one business. On the other hand, when you buy an ETF, you're investing in dozens, hundreds, or even thousands of different assets all at once. Some ETFs hold only stocks, others might include bonds, real estate, or even commodities like gold and oil. And some ETFs mix all of those together. Imagine your investment portfolio is like a playlist. A single asset ETF is like a playlist with only pop songs. But a multi-asset ETF is more like a carefully curated mix of pop, jazz, classical, and even a little rock. In other words, commodities. It gives you a variety of rhythms and moods, just like a diversified ETF gives you exposure to different parts of the market. This built-in variety is what makes ETFs so popular, especially for beginners, because it gives you instant diversification. You don't need to research and buy 50 different stocks on your own. One ETF can do that for you. All right, so now that you know the what of ETFs, let's look at how to actually buy them. First up, do you need a brokerage account? Absolutely you do. A brokerage account is your gateway to the stock market. But don't worry, it's not nearly as complicated as it sounds. Think of a brokerage like an online store, but instead of shopping for clothes or groceries, you're browsing through investments, stocks, bonds, ETFs, and more. But before you can start adding investments, you first need to open an account and transfer in some funds. Now there are two main types of investment accounts most investors start with: a standard taxable brokerage account or a tax-advantaged retirement account, like a 401k or IRA. So which one should you choose? Well, it depends on your goals. If you're saving for something in the next 5 to 10 years, like a house, wedding, emergency fund, or building wealth outside of retirement, a taxable brokerage account is a great place to start. It's flexible and gives you access to your money without early withdrawal penalties. But if you're focused on retirement, then a tax-advantaged account like a 401k, traditional IRA, Roth IRA, or SEP IRA is the way to go. These accounts come with tax benefits that help your money grow more efficiently over time. And the truth is, most people need both. And personally, I use a mix of taxable and tax-advantaged accounts to balance my short and long-term goals. My taxable accounts give me flexibility. I can invest, sell, and withdraw funds anytime. Meanwhile, my retirement accounts, like my Roth IRA, HSA, and SEP IRA, are all about maximizing tax advantages and building a strong financial foundation for the future. Quick side note. One common mistake new investors make, especially with retirement accounts, is assuming that once they open the account, they're automatically investing. But here's the thing. If you don't actively choose your investments, your money will just sit there as cash, not growing. So don't forget to pick your ETFs or other investments once your account is open and funded. And as for where to open an account, I personally use Charles Schwab and Vanguard. They offer low fees, easy-to-use platforms, and a great selection of ETFs. But there are plenty of reputable options out there, like Fidelity, Robinhood, M1 Finance, SoFi, and Webull. Take a little time to explore and choose the one that fits your goals, style, and location. So now let's tackle the big question. Which ETFs should you actually invest in? Did you know there are currently over 3,100 ETFs traded on the U.S. stock market? Now that might sound like a lot, but consider this. There are about 6,000 individual stocks, which means ETFs already make up about half as many investment options as individual stocks. With so many ETFs available, it's easy and totally normal to feel overwhelmed. But don't stress, because I've got you covered. Instead of trying to sort through thousands of ETFs on your own, what we want to do is narrow down that massive list and pick just a handful of ETFs that perfectly match your investing style. This simplified strategy, often called the 3 ETF portfolio, is a fantastic way to cut through the noise and stay focused on your financial goals. And in just a bit, I'll give you a clear, easy-to-follow list of ETFs I think are some of the absolute best out there, clearly organized by investing goals. But first, here's something important to keep in mind. The real key to choosing the right ETFs is knowing why you're investing in the first place. Ask yourself, am I investing for retirement, looking ahead 20 or even 40 years down the road? Or do I want to build a steady stream of passive income today through dividend-paying ETFs? Perhaps you're younger and can afford to take on more risk, so you're interested in aggressive growth ETFs. Or maybe retirement is just around the corner and stability through money market ETFs is your priority. Getting clear on your investment goals first makes choosing the right ETFs so much easier. Always keep these goals front and center and let them guide you to the ETFs that will best help you achieve financial freedom. Now let's say you've narrowed down your huge list of ETFs to a few favorites. Before you invest your hard-earned money, you'll want to take a closer look at each ETF's profile. This is where the real analysis begins. An ETF profile is like a snapshot. It gives you all the key info in one place: what the ETF invests in, how it's performed over time, what it costs to own, and how risky it might be. And here's the thing. Even if an ETF sounds great at first, digging into the profile helps you figure out if it actually fits your goals. This step is what separates casual guesses from confident investing. Luckily, finding this information is super easy. Let's continue with VOO as an example. All you need to do is type the ETF's ticker symbol, VOO, into Google. Right away, you'll see results from trusted finance websites like Yahoo Finance, Vanguard's official site, or even competitors like Fidelity. Now, the first thing I check is the product summary. This section gives you a high-level overview of what the ETF is all about. Continuing with VOO as our example, let's break down a few of the bullet points. First, it says this ETF invests in stocks within the S&P 500 index. That tells me I'm getting exposure to 500 of the largest U.S. companies, a great way to get instant diversification. Next, it says the goal is to match the performance of the S&P 500, which is often used as a benchmark for how the overall U.S. stock market is doing. In other words, if I invest in this ETF, I'm essentially investing in the broader U.S. economy. Quick side note, there are ETFs like VTI that aim to cover the entire U.S. stock market, including small and mid-sized companies like Mattel, the maker of Barbie, Hyatt Hotels, and Gap. The S&P 500 doesn't include any of these, but it's still one of the best indicators of the market's overall health. All right, so jumping back into the profile. Next up, it points out that this ETF offers high potential for investment growth, but with more ups and downs compared to something like bonds. Translation? This fund is built for long-term growth, but you'll need to be comfortable riding out a few bumps along the way. And finally, it wraps up by saying this ETF is best suited for long-term goals where growth is key. So, if you're investing for retirement or looking ahead 10 to 20 or even 30 years, this could be a great fit. But if you're going to need that money in just a few years, you might want something a bit more stable. Reading the product summary like this helps me know, right off the bat, whether the ETF is even worth considering further. This product summary section is a huge time saver. If I read this and it doesn't align with my investment goals, I already know I don't need to waste my time digging into the rest of the ETF profile. On the other hand, if everything lines up with what I'm looking for, I'll dive deeper into its holdings, expense ratio, and historical performance. So, always start with the product summary. It'll quickly tell you whether an ETF is worth considering or if you should move on to the next one. Next up is the expense ratio. This is the annual fee the ETF provider charges to manage the fund, and it's listed as a percentage. For example, VOO's expense ratio is just 0.03%. This means for every $100 you invest, you're only paying 3 cents per year. Now, this might not sound like much, but over time, fees can eat into your returns, especially if you're investing for the long haul. Let's check out a quick example. If you invested $10,000 in a super low fee ETF like VOO and earned 8% a year, you'd have almost $46,000 after 20 years. But if that same $10,000 were invested in a fund with a 1% fee, you'd only have about $36,000. That's a $10,000 difference just from fees. So yeah, that tiny fee makes a big difference over time. Always keep an eye on it. The next thing I always check is the ETF's performance, and here's a quick tip. Don't get too caught up in the one-year return. Any ETF can have a really good year or a really bad one. What you want to know is, how has it performed over time? Here's what I look at. 5-year returns. This gives you a solid, medium-term view of how the ETF has held up. 10-year returns. This shows how it's done across multiple market cycles, including ups and downs. And since inception, which helps you see the fund's full track record from the beginning. Looking at these longer-term returns gives you a much better sense of whether an ETF is consistently performing, not just getting lucky for a year. Another key part of the ETF profile to pay attention to is the market sector allocation and top holdings. This section shows you which industries the ETF is investing in and how much of your money is going into each one. Let's continue with our example, VOO. About 30% of the fund is invested in tech, in companies like Apple, Microsoft, and Amazon. That means nearly a third of your money is riding on the performance of the tech sector. Why does that matter? Because sector exposure can affect your risk. If one sector makes up a big chunk of the ETF and that sector takes a hit, your investment could feel it more than you expect. It's something we'll talk more about later when we cover diversification and fund overlap. Now, the last thing I check on an ETF's profile is distributions, or simply put, dividend payments. If you're unfamiliar with dividends, don't worry, I'll cover them in more detail later in the video. But for now, all you need to know is, does the ETF pay dividends? And if so, how often? Some pay quarterly while others pay monthly or even annually. This matters if you're looking to build passive income, as dividend-paying ETFs can provide cash flow while you continue to invest for growth. Taking a few minutes to analyze these key details, performance, sector exposure, top holdings, and dividends, can help you make smarter, more informed investment decisions. So now that you know how to analyze ETF profiles, let's talk about something a lot of new investors overlook, fund overlap. You might be asking, what is that? And why should I care? I get it, but trust me, it can seriously hurt your long-term growth if you're not paying attention. Fund overlap happens when you invest in multiple ETFs that hold many of the same stocks, or stocks from the same sector. And while that might sound harmless, what it actually does is reduce your diversification and increase your exposure to the same companies, completely defeating the purpose of spreading out your risk. Let's look at a real example. You might think that buying both VOO, which tracks the S&P 500, and VTI, which tracks the total U.S. stock market, gives you more variety. After all, VO holds about 509 stocks, and VTI includes a broader range with over 3,500 stocks. But here's the catch. 497 of the 509 stocks in VOO are also in VTI. That's a 99.6% overlap in holdings. Even more striking, the overlap by weight is about 88%, meaning the bulk of your money in both ETFs is going to the same top companies. So, while it may look like you're spreading your money out, you're really just doubling down on the same set of companies. This reduces your diversification and can increase your risk if something hits those companies or sectors hard. And you might be thinking, but wait, aren't these great companies? Isn't more of a good thing? Good? It's a fair question, and we will break down exactly why too much overlap can limit your growth, increase your risk, and how to avoid it. But first I want to point out that sometimes what looks like overlap is actually intentional. This is known as a portfolio tilt, when investors purposely lean their investments towards certain types of stocks, like small cap companies, fast-growing tech, or dividend-paying giants. Let me show you what that looks like in action. Here's a visual comparison between a balanced portfolio and a tilted one. You can clearly see how the tilted version increases allocation to small cap and tech sectors, while reducing exposure to bonds, dividends, and international assets. This kind of intentional shift is exactly what we mean by portfolio tilt. And some investors build and tilt on purpose by combining specific ETFs to get more exposure in areas they believe will perform well. And that's totally okay, as long as you're aware of it. The problem comes when people think they're diversifying, but what they're actually doing is doubling down on the same companies without realizing it. Instead of spreading their risk, they're unintentionally increasing it. So, if you're going to tilt your portfolio, just make sure it's a conscious move, not an accidental one. But how do you avoid fund overlap? I want to show you a super useful and totally free tool called Fund Overlap from ETF Research Center. It makes checking for overlap between two ETFs quick and easy. Here's how it works. Just enter two ETF ticker symbols like VOO and VTI, and the tool instantly shows you how much their holdings overlap. As you can see, 99.6% of the 509 stocks in VOO are also in VTI, and 16.5% of VTI's holdings are also in VOO. Now, 16.5% might not sound like much, but here's the important part. Look at the overlap by weight. This tells you how much of your money is tied up in the same companies. In this case, the overlap by weight is a whopping 88%. That means most of your investment is going to the same large companies. So what do you do in this case? Well, my personal rule of thumb is if two ETFs have more than 50% overlap by weight, I don't invest in both. Instead, I choose the one that best fits my strategy. So between the two, I'd personally go with VOO because it focuses on the 500 largest, most established U.S. companies without the added noise of thousands of smaller, more volatile stocks. And here's another reason. VOO has historically outperformed VTI. Now that might not sound like a huge deal, but over decades, even small differences can add up to tens of thousands in extra growth. Here's a visual comparison showing how $10,000 would have grown over 10 years in VOO versus VTI, assuming historical annualized returns of 12% and 11.5%, respectively. It's a clear example of how a slightly higher return can lead to a noticeably stronger outcome, and one reason I personally lean toward VOO in this case. Let's look at another example. Say you already own VOO, which gives you exposure to 500 of the largest U.S. companies, mostly in sectors like tech, healthcare, and finance. Now, imagine you're thinking about adding SCHH, a real estate ETF that invests in U.S. real estate investment trusts, or REITs. Now, some of you might be wondering, what exactly is a REIT? Well, a REIT is a company that owns and operates income-generating properties like apartment buildings, shopping centers, and office spaces. Think of it this way. Apple makes phones. REITs own real estate, like your local mall. Now here's what makes this pairing interesting. When you compare VOO and SCHH, there's very little overlap, only about 2% by weight. That's because these two ETFs are influenced by totally different economic forces. VOO tends to do well when the broader economy is growing and tech stocks are soaring. SCHH, on the other hand, is tied to the real estate market, so it reacts more to things like interest rates and rental income. In other words, they don't always move the same way, and that's exactly what you want when building a smart, diversified portfolio. This brings us to another important concept, portfolio correlation. In simple terms, correlation measures how two investments move in relation to each other. If they move in the same direction at the same time, they're highly correlated. If they move in opposite directions, they're negatively correlated. And if they move completely independently, they're uncorrelated. To give you a sense of scale, a correlation of 1.0 means two investments move in perfect lockstep. A correlation of 0 means there's no relationship at all. And a correlation of negative 1.0 means they move in opposite directions. In the case of VOO and SCHH, their correlation is relatively low, historically around 0.6. This means they don't always move in sync, which helps smooth out your returns over time. Why does this matter? Because real diversification isn't just about owning different investments. It's about owning investments that behave differently. If everything in your portfolio rises and falls together, you're not truly protected when the market gets bumpy. Quick side note, while diversification is important, you don't want to pick ETFs that are perfectly negatively correlated either, like a correlation of negative 1.0. That means when one goes up, the other always goes down, which can cancel out your gains and stall your growth. What you're aiming for is a low to moderate correlation, somewhere in the range of 0.2 to 0.6. That way, your investments don't all move the same, but they're also not working against each other. Now here's where real estate ETFs can really shine in your portfolio. Not only do they tend to have low correlation to traditional equity ETFs like VOO, meaning they don't always move in the same direction, but they also offer something many investors are looking for: steady, passive income. Because most real estate ETFs are built on REITs, and here's the kicker. By law, REITs are required to pay out at least 90% of their taxable income to investors in the form of dividends. That means when you invest in a real estate ETF, you're not just betting on long-term growth, you're also setting yourself up to receive regular income, making them an attractive option for passive income seekers. And now that we're talking about income, let's talk about one of the most underrated ways to build wealth over time: dividends. And more importantly, how to make those dividends work even harder through something called DRIP, or a dividend reinvestment plan. So let's break this down. What exactly is a DRIP? DRIP stands for Dividend Reinvestment Plan. It's a simple but powerful strategy where, instead of taking your dividends as cash, you automatically reinvest them to buy more shares of the ETF or stock that paid you. Think of it like this. Let's say you have $10,000 invested in an ETF growing at an average annual return of 8% and earning a 2% dividend yield. This means in the first year you earn $200 in dividends. Without a DRIP, in other words, no reinvestment, you receive dividends and either pocket them or let them sit in cash. With a DRIP, every dividend payment is automatically reinvested into buying more shares of the ETF, which means next time dividends are paid out, you'll earn dividends on those new shares too. That's compound growth in action. And over 20 years, the difference really adds up. The scenario without DRIP ends up at about $46,610. Not bad. But the portfolio with DRIP? It grows to more than $55,000. That's a nearly $9,000 difference, just by reinvesting dividends. It's like a snowball effect, and the best part? Once you set it up, it's automatic, no extra effort needed. This is why DRIP is one of the most underrated wealth-building tools, especially for long-term investors. And if you're unsure how to set this up, just Google your brokerage plus DRIP setup, and you'll usually find a step-by-step tutorial on your broker's website. All right, now that you've got a solid understanding of how ETFs work, let's talk about the moment you've been waiting for. How do you actually buy your first ETF? Don't worry, it's easier than you think. Here's how it works, step by step. 1. Log into your brokerage account. This is the platform where you'll actually make your investment. 2. Search for the ETF's ticker symbol. For example, if you're buying the Vanguard S&P 500 ETF, just type in VOO. 3. Click Buy and enter how much money you want to invest or how many shares you want to buy. Choose your order type. A market order means you want to buy it right now at the current price. A limit order lets you set the price you're willing to pay. 5. Review your order to make sure everything looks good, then hit Confirm. And just like that, you're an ETF owner. Most brokerages today make this process incredibly user-friendly. And yes, you can do the whole thing straight from your phone. All right, so I know we've covered a lot already, but stick with me because we've got 3 final topics to wrap it all up. And hey, if you've made it this far, kudos to you. But before we dive in, if you found this video helpful, go ahead and give it a like and drop a comment below. It's a free way to support the channel, and it also tells YouTube that this kind of content is worth sharing with more people. And of course, don't forget to subscribe and hit that notification bell so you never miss a new video. Okay, let's keep it going. Here's what's coming next. How much money do you really need to start investing? Where to find and research a full list of ETFs. And as a bonus, I'll share some of the best ETFs to consider, broken down by category. But first, let's talk about one of the smartest strategies for building wealth over time, especially if you're investing on a budget: dollar cost averaging. Dollar cost averaging simply means investing the same amount of money on a regular basis, like every week or every month, no matter what the market is doing. Let's say you invest $100 each month. In month 1, your ETF is trading at $40, so you buy 2.5 shares. In month 2, the price goes up to $45, so you buy about 2.22 shares. In month 3, it drops to $35, so you get about 2.86 shares. Even though the price is bouncing around, you're consistently investing the same amount, and over time, that helps you average out your cost. You end up buying more shares when prices are low and fewer when prices are high, which takes the pressure off trying to time the market perfectly. All right, now that you've got that down, let's dive into the first of our final 3 topics. How much money do you really need to start investing? The good news? Not much at all. Thanks to fractional shares, you don't need to buy a whole share of an ETF. So even if an ETF is trading at $400, you can start with as little as $1 or $5. Seriously, just a few bucks. That's one of the best parts of investing today. It's accessible. Now, of course, the more you can invest, the faster your money can grow. But the real game changer is consistency. Try to set up a weekly or monthly contribution, even if it's small. That way, you're putting dollar cost averaging to work for you, automatically. Sometimes you'll buy when prices are low, sometimes when they're high. But over time, it helps smooth out your cost and takes the pressure off trying to time the market. So now that you've got your budget and you know how to buy and analyze ETFs, the next question is, how do you actually find the ETFs you want to invest in? There are a few different ways to go about it, but one of my favorite free and powerful tools is the ETF database by VettaFi. It's an online platform that lets you easily search and filter ETFs based on things like cost, size, category, performance history, you name it. Super beginner friendly and incredibly useful. To make things easier, I've also dropped some helpful links in the video description to take you directly to popular ETF lists, like top performers, high dividend payers, and growth-focused funds. And if you want a simple yet powerful ETF combo to get started with, be sure to check out my next video, The Best 3 ETF Portfolio to Make You Rich, Simple Investing in 2025. In that video, I'll walk you through my personal favorites and why they work, especially in today's market. So be sure to subscribe and turn on notifications so you don't miss it when it drops. Okay, you made it to the end, and as promised, here's your bonus. Think of it as a quick start ETF cheat sheet to help you get going. Earlier, I mentioned I'd share some of my favorite ETFs by category, and here they are on screen. You'll see top performers in growth, dividends, real estate, and even money market ETFs for those looking for lower risk options. Feel free to pause the video and take a screenshot so you can save this list for later. One quick note. If you're considering dividend ETFs, it's usually best to hold them in a retirement account like a Roth IRA. Why? Because if you hold them in a taxable account, you could miss out on the full benefit of DRIP, the dividend reinvestment plan, since taxes can eat into your returns. Of course, this isn't financial advice, just some solid suggestions you can research further to build your ideal mix, depending on your goals, risk tolerance, and where you are in your investing journey. And that's a wrap. I hope this video helped clear up the basics and gave you some solid pointers on how to choose and manage your ETF investments with confidence. Let's quickly recap. Match your ETF picks to your personal investing goals. Watch out for expense ratios and fund overlap. Use free tools like ETF Database by VettaFi and the ETF Research Center to make smarter, more informed choices. Take advantage of DRIP to reinvest your dividends automatically. And don't forget about the power of dollar cost averaging to build wealth over time. If you found this video helpful, please give it a like and share it with someone who could use a simple, no-fluff crash course on ETF investing. And don't forget to check out my upcoming video, the Top 3 ETFs Portfolio to Make You Rich, Simple Investing in 2025. It's packed with real, actionable portfolio ideas to help you get started. Thanks so much for sticking with me to the end. I know your time is valuable, and I don't take that for granted. Hit subscribe if you want more content on personal finance, smart investing, and building long-term wealth.